Okay, we're going to do a brief video on moving average trading strategy and technical analysis. We're going to start with stocks, then we'll take a look at forex and maybe some futures. We want to first take a look at this chart. This chart is by TradingView, and this is set up as a bar chart for the period of days. And we want to first take a look at very simple way to set up a chart for technical analysis and for moving average trading strategy. See, basically what you're looking for is a moving average that you can compare to another moving average, and you compare all of the moving averages that you put on here to the prices. So let's go down here and select moving average. Let's select it again. Let's select it a third time. Now the first thing you want to know about a moving average is you have to set it up correctly. So what I like to do is first put it up so that I can read them. And so I choose green for the shortest, and I'm going to make that 5 days. Now these are classic. The first ones I'm putting up here are classic 5 and 20 day strategy. So let's just take a look here. That's the first one. The second one I'm going to set up red, and I'm going to do it for 20 days. And again, a 520 moving average crossover entry system is a very classic one, and they've written books on it and so forth, but you really don't have to put a whole lot of effort into it. The third one I'm going to make a very long-term 200-day. Now you can reduce that when you're not doing stocks, but this is helpful for stocks. So what we're looking at here is a 520 and a 200-day moving average, all three of them. And don't forget, we're also looking at the price. A lot of people don't look at the price in relation to the moving average, and that's one of the most important things you can look at. So let's take a look at this stock. This is Apple. Let's get an idea how far we're going back. This point right here is March 21, and this peak here is December 21. So whatever that is, about 9 months. Now we can look at this chart. We don't have to know much about moving averages, and we can see immediately that our 200-day moving average is clearly sloping up. That means we're in an uptrend. It's just that simple. So we're obviously oscillating fairly regularly, and you can see our 20-day moving average is clearly showing that. But there's some very interesting things going on here. The first thing let's take a look at is how closely price action is sticking to the 5-day moving average. That's unusual, and I'll show you some other stocks in a minute, but that is a very tight attachment of the price to the 5-day moving average. And you could really just stick with it and stay pretty straight in terms of you buy, it's above the 5 days above the 20, you buy and you stay with it until the 5-day goes flat or breaks the 20. And you could have caught a lot of that move if you just use that simple strategy. Now keep in mind, you can put all this in a computer, you can back test it. Trading with moving averages, if you back test it with computer algorithms, it definitely works, but it's not the greatest strategy in the world, and that's why I don't use it. It's very helpful to use moving averages to make a quick analysis of a stock. There's vastly better ways to trade, much more sophisticated algorithms that you can build, and we've built them here at rbmresearch.com. We'll show you some of those in a minute. But moving averages are great for just getting an idea of what's going on. So we can take a look at this stock. Up until this point was in a long-term bull market, and we could have easily caught some rallies, in my opinion, just buying the 5-day crossover of the 20, staying in it until it went flat or crossed back below the 5-day 20. So you could have done those simple kind of trades. You can see here you had a hard break of the 20, break to the downside by the 5 and the 20, and then that shorted you down, whatever that was, about 10 bucks. Again, you had a reasonably hard break above, and then that took off again. We had a test here which would have probably stopped you out. But that's the other thing. When you're trading with moving averages, if you're trading with them for signals, you have to use wider stops, and you have to have bigger capital count. So it's just the way it is. But you can definitely use them, and they definitely work. So you can see, if you're astute, that this was really tight following the 5-day moving average here. You can see it got sloppy through here. It had multiple false closes below the 5-day, and those would have given you some heartache. If you're an experienced trader, you understand that this space, this area underneath the 5 and above the 20 is telling you a lot about what's going on. You'll notice this space was clean, and there were really no entries in the price into that space. You notice here it was not clean. Even though it was still a fairly good area, a fairly wide area, you had a lot of entries in here, which told you that this was that the mentality of the traders had changed. They weren't sure what was going on. Here they were driving the price up. Here they weren't sure what was going on. Now, here's where it gets very interesting, both from a technical analysis perspective and from a moving average perspective. When you're looking at a moving average trading strategy, you have to understand it's for rallies or for declines, for bear markets, which we'll look at in a minute. When you're talking about a sideways market, using moving averages is not the way to go. I can think of a lot of better ways to do it than moving averages, and I can think a lot of nightmares of using moving averages. This is all in my opinion. But once you see these averages, these longer term averages start to go flat, like you see this 20-day start to go flat here, you don't really want to rely on these anymore. You can see the 5 is whipping you back and forth, oscillating up, over, and above. Sure, can you trade some of those? Of course. When it's crossing over the 20-day, this 5 days crossing over the 20-day, and it's staying tight against the price, you can trade that, but not necessarily a great way to do it. But you can definitely do it, especially in a stock that has demonstrated in the past that hugging a 5-day moving average is a good indication it's going to continue to go up. But again, not the best strategy to use a moving average when you have what I'm demonstrating here to be a sideways market. Now, when you saw this lower top and this lower bottom, an astute trader is going to say, hey, if this made a lower bottom and I get a good rally and I don't make a new top, there's a really good chance I'm going to be able to short this stock. And you can short it just outright, or you can short it synthetically with put options, and there's other ways you can short it. But let's take a look at it real quick. If we're looking at this and we're thinking of going short, we have tremendous volatility around the 5-day moving average on the price. That's not giving us a whole lot of confidence. You can see here it closed above the 20-day, not giving us a whole lot of confidence. So again, use your head when you're really thinking of considering trading with these moving averages. You have to have a pretty good gut to go from 153 to 166 to hold that rally if you're short this stock. That's a large move. And so I want to keep in mind when you're talking about trading with moving averages, that's what you're looking at doing. You can use moving averages, you can make a ton of money with them, but you really have to have an idea of what you're doing, and you have to use wide stops, in my opinion, and you have to have the stomach for it. Now again, the 200 came back into play. We had a close below the 200 moving average here. This fooled a lot of people and cost people a lot of money, because most people would have thought that was a sell signal, but you'll notice the moving averages never violated it, never went below it, and so that price turned around and rapidly got people for whatever that is, $25, $30, close to $25 or more. So you have to be careful. When it did finally break the 200-day moving average and you got a 5-day break on it and a price confirmation as well, then you could see we went down to roughly 136 from 159. So you picked up over 30 bucks. So you have to kind of put all three of these together, a 5, a 20, and a 200. You can adjust the 200 a little bit. Sometimes it's just not meaningful, and you can reduce it. You don't want to really go much longer than 200 because it gets too flat. But the 5 and the 20 are very reliable ways to analyze most stocks. If you take a look at Target, for example, Target's been having all kinds of issues, and you could have seen those issues coming if you had a 200-day moving average on here. This is Target, the retail department store. You can see Target was in a huge bull market here. This is, again, the 200-day moving average, the 20 and the 5-day moving average. You can see how tight it was sticking to the 5-day moving average, how tight. Same thing as the previous stock we looked at, how tight. So you were good there using these. You can see how it stayed below that for the most part if you're going to short this or buy puts against it. But when you violated this 200-day moving average here with your stock price and your 5-day, that was your signal to bail out of this stock. And you can see people waited for that rally to come up, test the 200, and they bailed out. And when they did, you got this huge sell-off. This sell-off, you could tell if you're in this distance here from the 200 to the 200-day moving average to this price here, that's just statistically too far. You can build models that show you how far this should be on average. This exceeded the standard deviation of those models, and you were statistically ready for a rally, and you'll see you got a huge gap. Is that going to happen every time? Of course not. But you had a really good heads up that you were going to get a rally, and you got a huge gap. This essentially came up, made a false close above the 200-day, and this captured a ton of people off guard. I guarantee it. And when this broke back down you'll notice we barely got a confirmation from the 20-day before it rolled right back over, and we got this enormous gap, which slapped a lot of people very painfully. I can't, what is that off the top of my head? That's, let's just call it just a ton of money. 50 bucks, $40, $50 gap there. That's an incredible amount of gap for a stock that averages 5 million shares a day. So you could use these moving averages on target to see, hey, my bull market's ended, and I need to start doing something other than looking at moving averages because they're slapping me like crazy. You could have, if you were skilled, used your 200 and bounced off and maybe gone short, but this is much more skilled, much more experience and skill required to trade moving averages in the sideways markets. You can do it, but there's other better ways to do it. So let's take a look real quick. If you're interested in some forex, let's see if we can find them. My futures are not coming up here, so we'll skip it. But let's go down here now. We've discussed how you can use moving averages, moving average trading strategy and for technical analysis. Let's go down here and look real quick at what we could have done on, let's just say Amazon. And instead of doing it with the moving averages that we just did, let's go down here and take a look and see what this says. This is RBAM Research algorithmic generated trading entry prices. Let's go back up here and put this back to Apple, because it's the first one. We're having problems with all this. So here's Apple, and we can see now that Apple has kind of begun. The 200 is flat, the 5 is flat, and the 20 is starting to trade a little flat. This is a perfect area to move away from moving averages and move into algorithmically generated trading signals. And if you move right down here, we can take a look. We generate these every day. These are the ones that are available for the 7th of June. And we put them out for stocks. We put them out 1-day hold, 5-day hold, and 20-day hold. Now, these don't have anything to do with moving averages. We generate these statistically from our algorithms for each of these stocks, and we cover 194 stocks. So today, if you were interested in short-term trading up to 20 days, you could take a look at our prices, and if your own analysis validated it, you could use these as buy prices or something similar. Again, after you analyze it yourself with your own judgment, and maybe get in the market, it's something similar to these. Now, how these work on the 1-day hold, you can get in here at 143.85 or something similar, and you hold till the end of the close tomorrow, worst case, or you take a profit if you get it as soon as you get it. So take your profits as soon as you get them, or close them worst case at the end of trading day tomorrow. Same thing here. These are actually, these stocks are 5. This column is mismarked, but this column is a 5-day hold. Here it is right here. So for Apple, if you want to do a 5-day hold, 144.76. If the market hits it, you could buy that or something similar. Again, if your own research indicates it's a good buy, you take a profit as soon as you get it. If you don't get a profit, you close it out worst case of the loss at the end of 5 days, and the same thing for the 20-day. Now, the difference in the holding periods are, as you extend your holding periods out, you get a slightly higher chance, a slightly higher probability of a profit, and you get a slightly higher average profit. But keep in mind, even on a 20-day, if you bought that today at 145.68, you may take your profits today. You may take them tomorrow, may take them in the 3rd day. You do not hold the whole 20-day period of time. You take a profit as soon as you get it, or worst case, close it out at a loss no later than the 20 days. That's how this works. So these are for short-term trading when the market, again, is trading sideways. It's vastly more, in my opinion, a vastly more robust way to look at it than to try to guess what's going on with these moving averages. Moving averages are great if you're experienced at looking at them for a trending market, but when the market goes sideways, these algorithmically generated prices are fantastic. We cover the stocks, we cover futures, we cover forex, and we cover Bitcoin for the futures. If you're interested in these, you can get them every morning before 7 a.m. Absolutely no cost, no credit card. 190 stocks, the major forex pairs, Bitcoin, and the most liquid futures at rbamresearch.com. There's a link below in the description. They're updated Monday through Friday, every weekday by 7 a.m. If you like this video, please click the like button. If you want to, please subscribe. And keep in mind, everything on this website, including the entry prices, are for entertainment purposes only. You cannot use them on their own. You must use your own research and just use the entry prices for reference. And you definitely trade at your own risk. Please consult a financial advisor if you feel you need one.